All right, welcome to the portfolio recaps for September 2018 for the Adaptive Wealth portfolios. This month, I know there's a lot that has gone on in October since the turn of the month, but this is just going to be focusing on the September performance. I will be updating with another market commentary later this week on what's going on right now and to try to give you some greater clarity regarding the current market movements and the like. But this is going to be focusing on, as of the month of September, how all the different portfolios are doing, as well as the strength of the economy. So when we first look at the summary of global markets as of September 28th, we see that the market returns over the past month have largely been positive. There are some negative areas in there. As well as, the bond markets are always looking a little bit, have been looking, a little bit shaky ever since the rising interest rate environment began. But, when we look at international stocks, we see that there is, a variety of up markets and down markets, a little bit more mixed. And same thing goes with like commodities and the like. But let's first look at the growth markets and see what happened there this past month. So first up, we have commodities leading the pack. These typically start to, do a little bit better in times of uncertainty, as well as, when oil starts to recover and things like that, as we have been seeing. We then have the Dow Jones and the International Developed in the EFA coming in second there, and then followed by the S&P 500, and then emerging markets, the Russell 2000 and U.S. real estate all falling behind. Now, the Russell 2000 has been lagging considerably and has started a decline there in that during the month of September here. But as you can see, right here, there's a little bit more shakiness. This was around, or the 26th was the announcement that the Federal Reserve was in fact going to continue raising interest rates. And, that has sent some more uncertainty into the markets in terms of, its effect on the overall stock valuations and the like. And I'll be getting more into some of the factors playing into the current issues in future commentaries that I'm going to release. But as of September, it's started a climb. There were some trade tensions that were abated, and then some got reinvigorated towards the end of the month. But when we're looking at the United States, Mexico, and Canada, those talks went well and and turned into a new agreement, the U.S. MCA, the United States, Mexico, Canada agreement. And that gave the markets some boost during the month of September. As we see, since year to date, here we see that the Russell 2000 is still leading the pack despite having a worse month than the larger cap stocks, and then followed by the S&P 500. Down there at the bottom, we still see emerging markets. They have been lagging this entire year, as have international markets, international developed, but we do see them rallying a little bit towards the end of the month. But real estate, of course, just has been very variable. As you can see, earlier in the year was much further down. It has come back a bit, but it did decline over the past month. And over the past 12 months, we see again U.S. stocks up at the top with the Dow Jones, the S&P 500, Russell 2000, and then commodities edging up there into third place now. Of course, commodities are going to be very volatile depending on just the spot prices and the expected future prices, as people are betting on the resurgence of oil and energy and the like. But then when we look at down here, we see again U.S. real estate down there. U.S. real estate heavily affected by interest rates. When interest rates start moving up, that creates higher borrowing costs for real estate, and can help put pressure down on that. Despite things like housing starts and new housing going in each month, it's been just downward pressure on that market due to the current environment. Then we see that international developed and emerging markets are both still, lagging the pack over the past 12 months, but in emerging markets, the sole negative performer there. In the bond markets have not been a happy place throughout this year, but this month especially. And when we're looking at U.S. aggregate bonds, we see that that's down there towards the middle of the pack, losing about 0.5%, followed by inflation-protected securities. The U.S. 10-year and 20-year treasuries really getting impacted by rising interest rates, as is normal with long-dated treasuries in a rising interest rate environment. But as mentioned before, we did see the Federal Reserve confirm that they were going to raise interest rates again on the 26th, and that was very much built into the price throughout this month here. Like as people were more and more certain that interest rate hike was coming, it exhibited, or it placed a lot of downward pressure on the bond markets and caused those negative returns for the month. When we are looking at year-to-date returns, we see that 20-year treasuries still performing the worst, and on a significant decline between August and September after rallying a bit in August. U.S. aggregate bonds just a bit below, or just shy of being at a 2% deficit for the year, 2% loss for the year to date. And international bonds and junk bonds are still leading the pack there, with high yield bonds at 1.8% and international bonds at 1%. International bonds not, haven't seen a whole lot of upward momentum or trajectory there, but they still have been pretty steady compared to the rest of the U.S. domestic markets for bonds, and have provided a little bit more stability in the bond markets. The same goes over the past 12 months. We see that international bonds are still up there at the lead, followed by high yield bonds, which are very much linked to the stock market. And then we have U.S. aggregate bonds around 1.33% loss for the past 12 months, and 20-year treasuries and 10-year treasuries down there at the bottom. When we're looking at global returns, we see that the U.S. and Canada, they're both under 1% for the month, but we see that some of the emerging markets had a better month than others. We see that there's some mixed movement over there in the European markets, and the same thing with the Pacific markets. But the top three returns in developed markets were Japan, Sweden, and Norway. Not in any particular order, I just read them off that way. And the bottom three, Netherlands, Ireland, and Portugal. Year to date, we see that Brazil's still very much down year to date, helping drag down those emerging market returns, whereas China's not quite as down, and Russia is actually up year to date. But when we're looking around the EU and the various European markets, we see a very, very mixed bag over there, with the United Kingdom negative, whereas France and Switzerland, either flat in the case of Switzerland or positive in the case of France. And then Pacific markets largely down, but Japan earning 1.3% year to date. And as you can see, the United States, it has just been leading the pack very much so compared to every other developed country year to date. When you actually break it down compared to the rest of the world, like when you're looking at a world index like MSCI World, the large majority of the returns from that have been from the United States' allocation in a global portfolio. And over the past 12 months, we see again the United States leading there, as has been the trend, and very much mixed bag in Europe, mostly single-digit returns, and the same goes for Pacific markets, where we see Japan just shy of double digits there. But the United States, again, has been the stock market to watch over the past 12 months. In terms of the different sectors, we see that things like healthcare and energy have been leading the way over the past month versus technology, which was basically flat for the month, and financials, which lost a bit, lost 2% for the month. And actually seeing, some little bit of positive return there for consumer staples, which has been, lagging the pack versus the rest of them for quite some time. When we look at year to date, we see that technology is up 19%, consumer discretionary 19.8, healthcare 16.36, whereas you have more defensive stocks like utilities and telecom and consumer staples, all very much either single digit returns in case of utilities, or negative returns over there. And financials has just been about flat this year. They've had a mixed bag due to rising interest rates as well as some other concerns. And over the past 12 months, we see financials about 9%, consumer discretionary leading the pack at 32%, technology at 30%, and healthcare at 18.8%. Again, we see utilities 2.67%, consumer staples 2.62%, but do see that rally there in energy companies. When you compare that to the S&P 500, you can see that the growth stories have been consumer discretionary and technology and healthcare, with everything else just being much more of a mixed bag, where you have energy and industrials up there that are slightly lagging the S&P 500, and then a lot of these, are just defensive sectors or interest rate sensitive sectors that have been struggling much more. Looking at market trends, we see that the S&P 500 at the end of September was above all of its different trend indicators that we're looking at here. And whereas international developed, the 50-day was under the 200-day moving average. The current price is just barely gone up above its 50-day. And, it just has very low 6-month and 12-month momentum. When we're looking at U.S. bond markets, we see negative momentum on both counts in 6-month and 12-month. When we are looking at its, if it's above or below its 200-day moving average, we see that it is just below its 200-day simple moving average, but its 50-day moving average is still above its 200-day. And so not every single trend indicator is going down, but of course, as we've seen since then, some things have been going a little chaotic since then. So this will be all upended in future commentary. But when we're looking at international bonds, we see that international bonds current price, went below its 50-day simple moving average, but its 50-day is still above its 200-day simple moving average, and it almost got into oversold territory there. We'll see, like I said, in future commentary how things have been progressing in all of these different markets. But at the beginning of the month or the end of last month, we see that the United States still has 100% bullishness. And these are all reactionary trends. This isn't if you're in a long-term uptrend, it takes a lot to knock you out of that. We're going to be looking at the economy and the economic indicators next. But even though since then it's been a little bit shaky, we still are in an uptrend, an uptrending environment. But whereas long-term treasuries have been struggling very much, U.S. aggregate bonds have been struggling. The Pacific markets have been struggling, and now international bonds have started to wane a little bit up there. When we are looking at the economic strength index, though, we see that the economy is roaring along on all cylinders. We are seeing some of the best ever signals from everything from, manufacturing to services to a lot of different sentiments when you're looking at consumers and the like, and when you're looking at job numbers, you see that we're at some of the best all-time jobs numbers for unemployment and the like. So overall, or at least very, very strong in the upper echelons, overall, the economic strength index is at the 100th percentile. So when we're looking at and comparing, trends in the markets versus, how the U.S. economy is, what this is essentially saying is, okay, the economy is strong, the economy is still growing, right? Its year-over-year indicators are still growing. So when we combine that with a lot of the other trends, we can have a different story. So if we have a market that's still in an uptrend, or even reverses from an uptrend, like say there's a shock to the market and it's going up, goes down, if the economy is still strong, the economy can absorb that shock right there and it can continue on. If you think about very sharp declines like the 87 crash, the market went down like 20%, but the economy, the ESI, in this case, when we're looking at the economy, when we look back there and simulate the results, we see that the ESI was still very strong then. It wasn't indicating a recession, even though that was like a 20% downturn. The markets bounced back. It takes a little bit sometimes for them to bounce back, but we're not, regardless of what's happening, we shouldn't really expect a long protracted decline when the economy is this strong. This isn't, anything that creates a shock to the market isn't going to, send it into a spiral, much like Lehman Brothers folding and going bankrupt did in the financial crisis, because the economy is just very strong and it can absorb all of that market volatility, and the market can start coalescing and correcting itself back up. Corrections are part of a healthy market. So keep that in mind as you're looking at a lot of the different news that's going on right now. We're looking at strategies. Here are the different benchmarks, the growth benchmarks: 80% world stock, 10% global real estate, 10% commodities. The income benchmark is 50% U.S. bonds, 50% international bonds. Equity benchmarks, the Russell 1000, which is the largest 1,000 companies in the U.S., much like the S&P 500 is the largest 500 companies. Then we have some blends of these. These take 90% of the growth, 10% of the income. Balanced benchmark, 60% of the growth, 40% of the income. And then we have some hedge fund benchmarks, because the models that we're utilizing are very much like hedge fund type models. And so we just want to see how are they doing compared to some of their hedge fund brethren. Then these are the strategies and the benchmarks that they're going to be compared to. And you can follow along here or come back here to just see, okay, how are these grouped? And essentially they're just grouped by overall themes, whether it's more of a core part of the portfolio, it's a growth kind of strategy, it's just individual equities, or it's more of an income theme strategy. When we're looking at 1 month returns, we see that Multi-Strategy Core had a negative 0.2% return, trailing its benchmark, which earned 0.22%. And Multi-Strategy Core Long Short Alternatives also trailed at negative 0.10%. But so Multi-Strategy Core fell behind its hedge fund benchmark, but Long Short Alternatives was a little bit better. But as you can see, not a huge movement. Whole lot of movement over the past month. Year-to-date returns, we see that Multi-Strategy Core here leads the pack at 3.52% returns versus 2.72% returns for the balanced benchmark, and Multi-Strategy Core Long Short Alternatives at 3.2%. Those all beat out the hedge fund benchmark that has lost negative 0.71% to date. You can see that down there with the green arrow. Over the past 12 months, we see that Multi-Strategy Core has earned 7.36%, Long Short Alternatives 6.5%, Balanced Benchmark 6.6%, and then the hedge fund index down there at 1.22. So the Multi-Strategy Core beat out its benchmarks. Multi-Strategy Core Long Short Alternatives fell behind the Balanced Benchmark by just a hair, but all three, both strategies and the passive benchmark beat out the Multi-Strategy Hedge Fund Index. When we're looking at growth strategies, we see that Multi-strategy growth eked out a positive return towards the end of the month with a 0.11% return. Long-short alternatives did slightly worse at negative 0.1%, and then aggressive growth at negative 0.1%. So not a whole lot of movement there. The benchmark was up at 0.52% though, and all three of those beat out the multi-strategy hedge fund index. Year-to-date returns, multi-strategy growth is up 7.1% versus its, or just is up 7.1% for the year, followed by the aggressive growth portfolio and the long-short alternatives. All three beat out both their 90-10 benchmark and their hedge fund benchmarks. Over the past 12 months, we see that multi-strategy growth is up there at the top at 12.5% returns, with multi-strategy aggressive growth at just under 10% returns there, followed by the 90-10 benchmark, and then finally long-short alternatives. Overall, they're following the trends, and some of them have kept up with the markets, some of them have exceeded the markets in terms of multi-strategy growth, but they will act differently in any given market. As you can see, they lagged earlier in the year. The multi-strategy growth rallied a bit more later in the year, and things will vary widely, but overall they've been performing fairly well this year. Income strategies. So here, this year has been tough for any income strategy. As you can see, even the 50-50 domestic and world bond benchmark there is down 0.39% for the month, and both the long-short alternatives and the multi-strategy income, those both lagged that benchmark there by just a little bit, whereas the multi-strategy hedge fund beat out all three and took the lead there. But year to date, we see that multi-strategy income and multi-strategy income long-short alternatives have lagged the both benchmarks, with the income benchmark at negative 0.36%, and again the hedge fund index leading the pack there, negative 0.21%. But overall, just been a very flat year, especially after multi-strategy income had such a monster year last year with a 10% or close to it return across the year, or at different times throughout the year. But when we're looking at the past 12 months, we see that multi-strategy income 0.16%, just barely positive. The long-short alternatives the same, whereas the income benchmark is 0.41%, helped by that allocation to international bonds, and the hedge fund index at 0.56%. Equity strategies. Well, actually, I'll just go back to here. When you're looking at a rising interest rate environment, income strategies are just not going to offer a whole lot of potential return. There's only so much you can do when you're only going long most of the income strategies. The long short alternatives, that's just going long in short currencies and commodities. So just to get a little exposure there and reallocate. So this is a sort of normal kind of experience during a rising rate environment, especially when you're coming from such low rates that we haven't really seen since the end of the Great Depression, rising into higher rates as we saw in, say, the 40s. So when we're looking at equity strategies, on the other hand, we see that adaptive momentum fell 0.68%, high quality value 1.31%, and shareholder yield 0.24%, whereas the Russell 1000 had a slightly positive month at 0.39%, whereas the hedge fund index lost 1%. So kind of in between the two benchmarks for most of them, with high quality value losing the most during the month of September. Year-to-date returns, adaptive momentum is up 16.6% up there, whereas high quality value is up 8.66%. The adaptive momentum beat out its Russell 1000 benchmark, whereas high quality value slightly behind. And shareholder yield has been struggling much more this year. As it is a yield-based strategy, it looks a lot at dividend yielding companies and companies that are doing a lot of the right things in terms of rewarding shareholders with value. But that has been performing the worst out of these equity strategies here, and as compared to the market. But all have outperformed their hedge fund brethren, which has lost 0.08% for the year. Over the past 12 months, we see that Adaptive Momentum is up 22.75%. When you're looking at trailing 12-month returns, this was almost up, or it was up around 30% last month. That also takes into account that you're rolling over 1 month on this end as well as on this end. So it just gives you if you were to include that extra month there, the 13-month strategy or 13-month returns would be higher for those, because that was a good month. But anyway, just to explain that. And then we have high quality value at 18.63%, which both of these beating out the Russell 1000 at 17.66%, and significantly beating out the hedge fund benchmark over there. Even shareholder yield, which has struggled a lot this year, did well over the past 12 months with just a little bit less than 10% returns. Just a summary of the different 1-month returns so you can see them all here. Please pause if you'd like to continue checking it out. Year-to-date returns and 12-month returns. Current portfolio allocations in the growth portfolios are U.S. stocks, U.S. bonds, and then alternative growth. In the income portfolios, we have U.S. bonds, stocks like dividend-producing companies and the like, and then a number of alternative income models. And then in a blended multi-strategy portfolio that goes 50% into the core strategies discussed here, 25% in the income, and 25% in the growth. It has the highest allocations to U.S. stocks, then U.S. bonds, then international bonds. Here's just a quick summary of those different markets, as well as the ESI down there. If you'd like to see your personal returns, please go up to the Adaptive Wealth website, adaptivewealth.com. Click log in and then enter your client or your email and password there, and you can log into your portal, see your returns since inception, your returns year to date, as well as your returns over the last month, as well as your current allocation. Here's some disclosures. All of these performance data are from my own tracking account. They don't include fees because there are several different types of fee structures, whether it's performance-based or assets under management that clients have. If you have any questions, please ask me about how these numbers were calculated and the like, and I will be happy to fill you in on any more advanced questions. Thank you very much for watching, and expect some more market commentary from me very soon about what's going on since the turn of the month in October, and especially this second week here in October. Talk to you soon, and just when you're looking at the markets and CNBC, remember that the economy is very strong, and that a lot of this is just market noise, the animal spirits kind of doing their thing, as Keynes called them. But I'll put some market commentary out here soon pertaining to exactly that. Thank you very much, and talk to you all soon.